How investment fees will kill the 4% rule and thus kill your retirement plan. Thanks for coming on board again with Heritage Wealth Planning, the place you come to learn about retirement planning to make it successful so you don't run out of money. I did this a few days ago, and unfortunately I deleted it by accident when I was messing around trying to change a little bit of it. So this could be a quicker version of the last one. So no good deed goes unpunished, my friends, but it's the same synopsis here. 4% rule is not going to work if you have investment fees, and I'll show you that here in a brief tutorial here. So dive in with me, if you will. We're going to bring back Scott and Melissa's sample. And again, just real quick, they're 65 years old. They're going to live until they're 95. They got $1 million. All right, that's what they got, $1 million between them. Nothing else. That's just they got $1 million. All right, so they got 600,000 of Scott's total stock index, 400,000 in Melissa's total bond index, and they're going to spend 4% a year. That's $3,333 a month, or $40,000 a year. And then we're going to adjust it each year with inflation. Inflation is 3%. 60-40 portfolio literally could not be any simpler. All right, so let's look at this and see how this works. So we're going to hit retirement. And this is just based on with no fees, by the way. And whoa, we only have a 67% probability of success. And this goes back to the reason why the 4% rule does concern you to some degree, is because the interest rates are way low relative to historical rates when the 4% rule came into being. And the likelihood of stocks giving us those pre-1926 to 1990s returns are probably kind of small. So I'm saying interest rates are 3% for bonds, stocks are 7.5%. Thus, you factor out a 3% inflation. You got a 0% real return on bonds, and you got a 4.5% real return on stocks. You take them together, it's roughly a 5.7% rate of return. Subtract out the inflation, is about 2.7 growth or net return, real return. That's before taxes. But hey, I'm still pretty comfortable with that 67% hit rate. No doubt about that. I mean, it's not 85%, but if we can get above 60, I'd still say, hey, at the end of the day, it's still like a little bit more to get it above 75 is generally where I'm looking for. So let's just say they retire at 66 instead and see what we got there, how much that changes things. And I imagine it'll change a little bit here. Let's see. No, not much. Okay, so it's really just a matter of the fact that they got 30 years and don't have that. They're taking 44% a year. I'm just curious. What if we do 3,000 a month? Let's just see real quick what that looks like, and that will change. Yeah, so okay. So 3,000 a month changes it. So $333 less a month will change the projection substantially. But that's not the reason I want to go into this, because don't forget the 4% rule didn't include taxes. And when you factor in taxes, which you have to do, we got to go to retirement, get my mug out of the way. We got to go to cash flow. And so when you factor in taxes on the 4% rule, and we're paying $3,000 there, $3,500 there. So the taxes will add another. And so let's just see here. We go to income flow or expenses, which is $42,432. And that was in 2021. Plus taxes, 2021, we pay another $3,752 in taxes, depending on what state you live in. Plus, how much was that again? Expenses, $3,752 in taxes, plus $42,432. So that means we're taking $46,148 out of that portfolio in 2021. And at that stage, the portfolio is worth $1.073 million. 1.073976. Yeah, so we're taking 4.3%. So essentially, when you factor in taxes, it's 4.3. No getting around that. All right, so let's go and we're going to add an expense real quick. So basically, because it's not truly a 4% rule, it's a 4.3% rule, what you got to do is you got to reduce the amount of income you need. I mean, because again, this is $3,333 a month, $40,000 a year, but we're actually taking $43,000 a year when taxes are factored in. So if you want to make this last better under the 4% rule, you got to factor in taxes. All right. Now, again, that doesn't concern me all that much. I mean, because I don't think you're going to spend the equivalent of $40,000 when you're 85 years old, but be it as it may. So let's go up here. We're going to hit profile. and we're going to hit expenses. So again, that leaves us some concern, but I'm not all that worried about it as we sit here today. And we're going to charge 1% a year in your managed fees. All right, so you're going to pay a 1% per year fee, and we'll just make this quick and ugly. Let's see what this puppy looks like now. Remember, 67% before, and let's see what it looks like now. And it's down to 50. So it's pretty significant decline there for sure, from 67 to 50. And again, it's 3,300 a month is what our retirement income expense is. And that's just simply because we're taking more and more out because of the taxes and because of the fees. So let's go back to cash flow. And that's a reduction. There's no getting around that. So now we're taking in 2000 and let's see, expenses in 2021 was 42,432 again, 42,432. This time we add how much was the tax again? Was probably going to be the same. Let's see, that's 2021. Tax was 3,752. So in 2021, we're taking 46,184 out of the portfolio, but now the portfolio is only worth 1.04 million. So divided by 1.04471. So now it's a 4.4%, going on 4.5. So let's just keep going down a little bit. So in here we got, we'll go to expenses right here, and we'll go down to 2035, 64,148, 64,182, 64,182. And then let's add taxes to it. That's 2000 and what is it, 35? Yeah, 2035. Add taxes to it. That's another 7,000 of taxes. So we're 64,182 plus 7,020 in tax. So we're totally taking out $71,200 out of our portfolio. And in 2035, our account is worth what? 1.075. So divide by 1,075,996. So now it's a 6% rate of return. So we're taking 6.6% a year as a distribution rate because of the taxes and because of the fees and that's just not sustainable. In fact, look, we only got $603,000 left at your death. Now, if we go back and get rid of we have $600,000 with the fee. How much do we have without the fee? Let's take a look. Let's get rid of this 1% fee. I guarantee you it's going to be more than $600,000. And so now we're saying our retirement, we're going to go to accounts here, cash flow, and then we go to accounts, and we've got, 1.4 million. So that's $800,000 you paid your investment advisor. And you're taking on more risk and you're taking on less probability of success for $800,000. Is that worth it? I don't think so. Not in the least. That's a lot of money, my friends. And so now let's go back and I want to show you something real quick, and then we'll get done with this because it ticked me off. I deleted my last one. My last one was actually a very good video, I thought, but no, well. All right, so now we got 1% fees. I want to show you something on the stress test when we go to retirement. And this, well, I love the right capital. Never mind the 1040 stuff that they show you, but I also like the stress test. So again, it's a 50% probability of success, but watch this. Is it hitting us? Yeah, here we go. Stress test. All right. So if a market crashes by 20%, we go from 50% probability to 32.7. And equity markets crashing by 20% happens all the time. Inflation will be higher by 1%. So we already have a 3% inflation there. We're going to add 1% of that. It drops from 50% to 33.3. We live 5 years longer to 100. We'd go from 50% to 36.1. I mean, that's just significant, man. There's no getting around that. That's a big deal with a stress test. And I don't think anyone would sit there and say that plan is on solid footing as you're going into retirement, especially when I just showed you're taking 6.6% a year off in only 13 years or so, no, 17 years. 2035, your portfolio withdrawals are 6.6%. And that's including a linear rate of return. We're not talking about the variations like that. We're talking about a linear rate of return. So let's just go back here and do the stress test when we take out the fees. Remember, this was 67% up. Yeah, 67%. Let's see what the stress test looks like here with no fees. I mean, so here the market crash drops us down from 67 to 52, and that's against a 20% market crash. We live another 5 years longer, drops it down from 67 to 55. Inflation is 1% more than it is now, so it's 4%, 52.6 from 67%. So, neither of these portfolios are just making me, sing just wonderful songs to the good Lord upstairs. But at the end of the day, I know for a fact the second one is worse because the fees will eat you alive. No getting around that. And finally, we just look at the tax, and then we'll just go into this is without the fees, by the way. Let's go to the details so you can see the 1040. We'll go up to 2035, where I show you how much you're pulling from the account. Now, this is just going to show you your tax. So here you're pulling $83,000 from the account, and you got to pay tax on $61,000 after your standard deduction itemization. So that's your tax right there. That's the feds. That doesn't include your state. So that, that's, again, you got to look at taxes, you got to look at fees if you're going to follow the 4% rule. And when you look at both of those, you got to be very, very careful because the fees are going to eat you alive. At the end of the day, the reason I don't get too caught up in the 4% rule, because that's what's called your safe withdrawal rate historically, which means the least amount you could take without ever running out of money. And the reason I'm not all that concerned with it, because that assumes, again, your spending goes up and up and up in each and every year. And I frankly don't think it's going to happen. I think it's going to go up and then fall off. But without question, you need to be prepared for your increase could continue on. And that's why a 4% rule is a nice place to start with for sure. But your investment fees are just going to delete that without, I just showed you. I just proved it to you using the software that we use. So anyway, as always, if you like what we see here, don't forget to subscribe. Comments always welcome for sure. Thumbs up, the comments, questions, concerns, put them on there. And then just go to heritagewealthplanning.com. You can see all my other posts, my podcasts, my videos that I do, and then my blog posts as well. We'll see you next time. Thanks, guys.